Hello and welcome to Tideline's Compass series on the state of the impact investment market. I'm Jane Bieneman, Senior Advisor at Tideline. This is our fourth annual State of the Market event. And in thinking about our discussion today, I took a look back at topics we've talked about in prior years. There has been an evolution from very foundational topics, particularly in the first year. What is impact investing? Who are the players? To more about how do we scale and build the market. We've always talked about opportunities and challenges. They have changed over time from what I'd call more internal issues, such as how do we, the engaged stakeholders, coalesce around voluntary standards, to more external issues. Today, external dynamics that we face include increased regulation, a very challenging fundraising market, and now that we as an industry have captured the broader market's attention, which of course is something early in our journey that we thought we wanted, that more awareness would drive growth. We're facing a lot of pushback in the US as well as in Europe. Tailwinds that we're seeing today include the enormous public investment in climate solutions, which is introducing impact to a whole new generation of investors, as well as the awakening of new regions, most notably Asia, to impact. So it's with a lot of optimism and celebration for where we've arrived, as well as questions about the future, that I come to our discussion today. And I'm delighted now to introduce our esteemed panelists, starting with Vikas Arora, who's Chief of Impact Investing at AVPN, Asia's leading social investment network, where he focuses on driving capital into the social impact space. Previously, Vikas had a 25-year career at Deutsche Bank. Beth Bafford is VP Strategy of Calvert Impact, where for the last decade, she's been building new products that drive impact. And she recently also became CEO of Climate United, a new $7 billion fund. Kieron Boyle is Chief Executive of the Impact Investing Institute, the UK's national body for impact investing. Kieron previously was head of Guy's and St. Thomas, which was one of the first foundations to integrate impact into its endowment. He also previously was Director of Impact Investment for the UK government, where his work included the creation of Big Society Capital. And this fall, Kieron will become Director of 100 Times Impact Accelerator, which supports Impact First ventures with the potential for very large scale. Zach Jackson is Principal at QIC, a $100 billion asset owner owned by the Queensland government. He leads efforts in sustainability, and over the last year has been working on a new and very exciting strategy focused on climate solutions. Fran Seegull is president of the U.S. Impact Investing Alliance and the executive director of the Tipping Point Fund on Impact Investing. At both organizations, Fran works to advance the field of practice of impact investing. She works across public and private markets and asset classes and sits very much at the center of activity in our market. So welcome all. It's wonderful to see you. Fran, if I could turn to you to get us started with our discussion. I'm hoping you can help set the stage for us by talking about what you're seeing broadly in the market in terms of activity and what you would highlight for us as important trends that we should all be aware of in the market.
Yes, happy to. But first, so great to be with you today. Thanks to Ben, Jane, and the Tideline team for convening us, and excited to be in dialogue with my fellow co-panelists. I have been saying lately that impact investing is at a crossroads, but it's also in the crosshairs. So I'll talk about both tailwinds and headwinds. So first, for the good news, the field has enjoyed extraordinary growth over the past 15 years since the term impact investing was coined. It has been enhanced, that growth has been enhanced for most of that time by a low interest rate environment and a fairly steady economy, albeit punctuated by the 2007 financial crisis and, of course, the 2020-2021 pandemic. There's an increasing understanding that all investing has an impact, though it has largely or exclusively been opaque to investors and stakeholders, and that we must factor that impact into our investment decision-making to address the climate crisis, to advance racial, gender, economic, and other equity, and to build a more resilient future. The market continues to grow with the entrance of more mainstream actors coming into impact investing, including some corporations, more pension funds, insurance companies, and others. And as you noted, Jane at the top, and Beth will talk about in a moment, in the US, there will be trillions in federal funds bolstered by additional trillions of private investment dollars flowing into communities for sustainable infrastructure, for clean energy, and community economic development projects. That said, we know that there are macroeconomic pressures mounting. Global economies are still working to fully rebound from the COVID-19 pandemic. And we have experienced years of uncertainty, inflation, and threats of recession remain. You also talked about asset managers, the climate for fundraising, Jane. That climate for fundraising has been especially challenging. Liquidity is tight in the private markets. And for many impact fund managers and diverse fund managers, those barriers are even higher, especially as investors in the United States are questioning existing strategies, given the political attacks on private sector DEI practices following last year's Supreme Court strike down of affirmative action in higher education. So that's a good segue into some of the headwinds. We think that the mainstreaming and momentum of the field has raised the hackles of the fossil fuel industry and other special interest groups. I'm sure many of you have been tracking the politically motivated attacks playing out in red states, playing out at the federal level, the federal government, and through the media against companies and financial institutions, and indeed investors that consider financially relevant environmental, social, and governance factors. As I mentioned, DEI is the latest concept to draw the ire of the right. And these attacks have had the desired chilling effect in some cases, with major asset managers, folks like State Street, JP Morgan, PIMCO, and others, pulling out of investor-led initiatives like Climate Action 100+, GFANZ, and others. Large corporations are scrubbing their public materials of mentions of DEI to avoid additional scrutiny. And we think that this represents an existential threat to the pairing of financial and impact considerations. And then finally, I'd be remiss if I didn't acknowledge this gravitational pull of elections this year, with more than 4 billion people voting in over 50 elections globally. Many are concerned, we think justifiably, that 2024 will lead to a hard turn to the far right, with significant ramifications for our democratic institutions. We've seen the most recent elections, and maybe Kieron will touch on this. Most recently, in the European Parliament elections, we'll be watching the upcoming snap elections in France, as well, of course, the presidential election in the United States this November. So just to wrap up, and impact investing is at a crossroads and in the crosshairs, given both the challenging economic and political environment. And it's our job to ensure the field continues to grow, continues to scale with impact and integrity to help manifest a more equitable economic system.
Thank you, Fran. Appreciate the overview and the call to action. And Kieron, I'd love to dig into these topics a little bit more with you in terms of sort of overall momentum in the market, and particularly thinking about the institutionalization. You've said in the past that we'll have exponential growth when we hit the tipping point in the market with institutional investors. How are we doing there? And given your role in government, what do you see as the role of policy in institutionalizing the market?
Brilliant. Well, thank you. It's great to be with you all today. And Fran, thank you. That was a really clear overview. So are we reaching that tipping point? Big picture, yes, I think we are. I think you'll probably find from all of us kind of a mixture of enthusiasm mixed with realism. I suspect that's where I would advise us to be right now. So there are two, I would say that behind this all, there are two structural trends that are playing out for institutional investors, neither of which are specifically impact investing, but play out very critically for it. So the first, exactly as Fran said, is a greater recognition of the impact of investments. So of the effect of wider externalities on investment performance, that this matters, it's something that you need to consider, needs to be part of a measured approach to high quality capital allocations. And look, that's set. That's here to stay. The second is the very clear growth that we're seeing in solutions-focused businesses. So enterprises that achieve commercial value through some form of social and environmental outcome, be that in clean energy or healthcare or food and agriculture and so on. Those are mega trends that are here to stay, and they create opportunities for impact investing within them. So we should be enthusiastic, right? Well, the realism is this is still very small, as Fran says, on the global scale. So less than 2% of global capital markets are engaged in this territory. It ought to be bigger. It can be bigger, and I think if you look around the world, you'll see pockets of where things are harder, exactly as Fran pointed out. Vikas, it'd be really interesting to hear about your perspective when you look at pockets of the world where it seems that there's greater acceleration of engagement with this method of investing as well. So the question is not if it will reach a tipping point. It will. It's not if it will kind of reach great scale. It will. It's how do we speed it up? And I think that's where policy is most important. And broadly, there are always three classic tools you can think about. Because what are we describing here? We're describing, particularly when we think about institutional investors, how do you get the market to clear? By which I mean, how do you get the value of these impacts to that occur in the world to be sufficiently valued? And it's going to be really helpful, Beth, to hear about broadly the incentives approach being explored in the US through the Inflation Reduction Act. You can look to points of the world where essentially governments are just essentially directing activity. That's another way you can get the market to clear. Clearly in Europe, there's a big push on a regulatory approach. So almost how do you set the admission price for anybody to be active in that market through regulations and activity in the UK. We've actually developed the world's first regulated impact label. So, kind of regulations are root. The fourth one, which I'm most interested though, is how do you start to change the rules of the game in total? And I think an interesting area there is around fiduciary duties and fiduciary responsibilities. And there seems to be increased engagement around this question of how do we balance today and tomorrow, which is ultimately what fiduciary duties are about as well. And if we can come to a view of investments that put an appropriate emphasis on long-term value creation, as well as short-term financial returns, that will probably be the thing that from a policy perspective accelerates this area the most.
Thank you, Kieron. That's so interesting. And no, I'll be thinking more about that but fiduciary duties, it feels in the US that we take a step forward and a step back on that argument. But building on your comments in particular on incentives, Beth, I'd love to turn to you. As Kieron mentioned, there's been a host of incentives we've had in the US recently around federal legislation providing incentives. Wonder if you could help us understand that legislation and its importance and how that's led to the Climate United Fund that you're leading.
Yeah, absolutely. And echo everyone's thanks to the Tideline team for pulling together this great discussion. So I'm going to try to very quickly summarize about $4 trillion in spending that is coming through the U.S. economy over the last few years. And first recognize that we are I would say we're behind, and so hopefully catching up and catching up quickly. But we certainly have been behind in terms of federal action to support this ecosystem that Fran really talked about in the U.S. But since 2021, there have been about $4 trillion in federal legislation. And I would say my summary of that is really looking at a federal investment in a holistic and integrated transition to a clean energy economy across all sectors and segments of the economy. So some of even the pieces of legislation that don't directly seem to be related are related because they put together important pieces of the puzzle that get us to a net zero future. And then the second piece, which I think is probably not as widely reported, is that through these pieces of legislation, there's been a real recognition and reliance on a network of community-based lenders and organizations to ensure that these federal dollars are actually getting down to the last mile in communities across the country. And some of it's a direct recognition of that ecosystem and some of it's indirect. But I think that has been the most pleasantly surprising piece for us, is really an understanding and appreciation of the federal government, that infrastructure, that on the ground community-based infrastructure needs to exist if any of these programs are going to be successful in meeting their goals. So just walking through just examples of that quickly. So there was the Consolidated Appropriations Act, very sexy name, that was passed in early 2021. Example of this community infrastructure, that's the program that had $9 billion to support community banks and credit unions across the country through what we call the ESIP program, as well as $3 billion to support nonprofit CDFIs across the country, community development financial institutions. So kind of first recognition of let's support and build these institutions that were critical in our response to the pandemic, in getting to small businesses and consumers across the country. Then there was the American Rescue Plan, which was a $1.9 trillion package. But within that, really critical support for state and local government infrastructure, as well as things like the State Small Business Credit Initiative. So recognizing the importance of access to credit for small businesses, that has been a pillar of the impact industry for decades, but an enormous federal investment in supporting those ends. Then we come to the bipartisan infrastructure bill, BIL, and all sorts of things in here. But as we talk about the transition, right, things that are critical, access to broadband, right? If we're thinking about how we get homeowners into, clean appliances and smart appliances, if they don't have access to internet, none of that works. So broadband access, public transit investments there, clean water infrastructure, which is critical, particularly in rural communities, investments in electric school buses. So even that legislation that not seem to be kind of a climate or impact bill has a lot in there that is investing in this transition. And then the Inflation Reduction Act, which is what kind of everybody thinks of as this critical climate legislation, which is another $800 billion investment, of which about $380 billion was focused on the clean energy transition. The primary driver of the investments in that bucket are tax incentives and rebates. So looking at how we're incentivizing corporations, people, homeowners into access to clean technologies. But as we all know that have been in the impact industry in a long time, tax credits and incentives don't often benefit the lowest income individuals across the country, and are not enough to make that choice or that transition happen. And so there is also a piece of the largest direct spending in the Inflation Reduction Act is the $27 billion Greenhouse Gas Reduction Fund, of which $14 billion went to the National Clean Investment Fund, essentially kind of a network of national green banks, of which Climate United was lucky enough to be one of the recipients. And so really looking at it, though, in the context of this bigger picture, which is how is the federal government investing in this ecosystem? And then how do we play a role in making sure that translates into direct and tangible benefits in people's lives? And so that's really the focus of our strategy at Climate United, is how do we enable that equitable transition but do so in a way that doesn't forget that what we're really after is, I say climate plus, right? So it's the transition plus access to affordable and healthy housing, plus access to quality education, plus access to wealth creation, income creation for families across the country, plus health of our communities, both direct health as well as health because of air quality and other issues. And so that's really what our strategy was built around. How do we support, take all of this momentum built by these this enormous federal investment, but really support that transition on the ground locally for communities in a way that makes the clean energy transition direct, tangible, and beneficial in people's lives. Becomes less about the kind of doom and gloom of climate change and more about economic and opportunity for families, kind of kitchen table issues that make sense for everybody. And how do we put together the right infrastructure financing packages in order to support and nudge people in that direction in a way that is really focused on the communities that often are left out of these transitions or left behind. And so that's really the focus of our work in the context of this much larger picture of what's happening across the US.
Thank you, Beth, and I really appreciate that you are bringing us back to the beneficiary, which we'll turn to a little bit later as well. Zach, turning to you and building on the themes we were talking about earlier around institutionalization of the market, would you talk to us about the opportunity in climate from the perspective of a large pension fund? What are you seeing from your peers, and what is it that has QIC focused on this area today?
Thanks, Jane, and really great to be with everybody here today. I'll probably just touch on a few things in our program and areas of interest, particularly given some scope, a little bit of perspective on the market and capital formation in our approach. But we as QIC, based in Australia, do have a global lens. So have been fortunate to really have that outward focus with local teams. We've had a lot of engagement with our stakeholders, which has been very good in that we've been able to spend good time and with great input, the ability to define our impact pathways, particularly as it relates to climate. So we're very focused on the pathways of mitigation and adaptation and categories that an industry sub-industry groups that fall underneath that. We are, to Kieron's point around fiduciary charge, looking at this as an opportunity. So see a lot of the funding shortfall as a private investor as an opportunity. And so think about our fiduciary charge commercially and see investable opportunity in a way that is sufficient for us to deploy capital in these categories that meet our private equity benchmarks. We do apply a traditional set of criteria in that we are just as rigorous with this as we are with anything else, and are still seeing things bubbling to the surface that would be on par with what we would put in our regular way private equity allocation. We do have some biases in terms of how we think about just markets, and we've seen success in private equity generally and have had to adapt some of those to form fit the maturity of the climate investment market, in that we've seen a lot of success in middle market private equity that's less mature. And the investable opportunity is smaller. There's been a lot of capital formation in case stages like venture, and there is a real pull on the other bookend for more listed businesses and greater diversification. So there is a need to develop a financing continuum in the middle of between early stage and listed businesses or something that might sort of fall under energy transition. And so see that kind of middle as an opportunity for us in that a lot of the technology, some estimates are something like 40% are emerging and 25% are existing. Those technologies exist to get us to transition. And so the skills required, and this has been some of the adaptation, has been in the sort of growth arena around how you think about I think the technical term is techno-economic analysis, but really it's getting to the right kind of unit economics in businesses that really necessitate the transition of somebody choosing something that does not only sort of cost effective or cheaper, but also better for the environment. And oftentimes that has a financial benefit based on certain policies and credits as well. And so can actually be, more a better ROI than sort of the commercial or maybe hydrocarbon alternative. So for us, that's been a big emphasis for us. I think that for someone who is thinking about this business model wise, we've had to become a little bit more constructive to sort of physical opportunity. It is about 50% of the market here. It is maturing in that there was something like $50 billion of impact funds raised in 2022. So a little bit dated, but I think the peak. And I think we all are aware that, some of the larger private equity funds, there was a $25 billion fund or two raised during, the 2022, 2023 period. So I think scale is definitely a consideration for institutional investors, and being thoughtful about sort of with the maturity of not only sort of the funding ecosystem, but the manager base. And so I think Fran mentioned earlier comments around emerging managers and capital formation there. We, as a private equity business, have focused on that category. Think that it's interesting. I think we, again, still apply the level of rigor and threshold around making sure things meet our underwriting criteria that makes sense commercially. But have a lot of experience in helping people who are forming, capital for the first time under maybe their own shingle or name, but with potentially experience and track record, thinking about the development of the business, because you're sort of in that way, not only investing in an area that you might have experience and conviction, but also trying to build a business and a franchise where we think long term and are supportive. But do see at the moment, and I think part of it was temporal. So from a timing perspective, the 2021 exuberance not being with us today is actually probably a welcomed reprieve, in that there is some softness in growth, I think to probably a healthy extent, and so we're not shying away. We also view this, I think, the private equity and private markets is not something you can buy and sell, kind of thinking about things on a 1 or even 3 year basis. It's something we're committed to for the long term. And so think about it sort of through market cycles and recognize the secular tailwind and opportunity set within particularly climate, given the sort of funding shortfalls that we can all agree that there is a significant amount of investment required. But pause there, and maybe we'll come back to some things to the extent the audience is interested in exploring other elements.
Thank you, Zach. Vikas, turning to you, would appreciate some insights into what you're seeing in Asia. We do see an increase of capital from where we sit at Tideline into sustainable investing in Asia. Our sense is that at times impact, quote unquote, can be conflated with climate or with responsible investing. And I wonder if you could speak to us about how you see the impact concept taking hold in Asia, and how you're becoming more connected, if that is the case, with the broader global impact investment market.
No, absolutely. Thanks. And a pleasure being on this panel. So in Asia, the concept of impact investing is gradually evolving and becoming an important topic in the investment landscape. I think there's no running away from there. And you're right that it does tend to get combined with or intermingled with climate investment or the broader responsible investment themes. And this overlap actually can lead to a lack of clarity amongst investors, potentially resulting in misallocation of resources. So something to be careful about. However, in this evolving landscape of impact investing, it becomes imperative for networks like ours and like some of the others on the panel to really lead the discussion and narrative on this topic. But needless to say, in an evolving landscape, there will always be challenges. So, the regulatory inconsistencies, we see that across Asia quite clearly. Different countries in Asia have varying regulations, creating uncertainty and complicating, regional investment strategies. So For example, if differing regulations on renewable energy projects in neighboring countries can make it difficult for investors to develop a cohesive regional strategy, for example. And then there's, limited understanding. So many investors still are unfamiliar with the concept of intentionality in impact investing, where investments are made with the explicit intention of generating positive social or environmental outcomes alongside financial returns. So this gap in understanding can be a barrier to growth of impact investing in the region. And then, of course, the lack of standardization. I think there's a pressing need for standardized impact measurement frameworks to ensure clear and comparable impact data, which is essential for impact and informed investment decisions. But clearly, there are opportunities. There's a large untapped market. So we all know that approximately $4 trillion are needed for Asia to meet its SDG goals by 2030. And there's significant opportunities in sectors such as clean energy, sustainable agriculture, healthcare, education. And for instance, the growing demand for clean energy solutions really present a substantial investment opportunities as countries strive to meet their climate goals. And then there are government initiatives, so tax incentives and supportive frameworks coupled with growing public support for sustainability to bolster these opportunities. So while impact investing is evolving, it is becoming mainstream. There's a lot of discussion around this, number of gatherings and convenings taking place, but it is really an evolving ecosystem at the minute. Jane?
Thank you very much. And I'd like to continue this discussion with the group around the topic of building the impact market globally. Zach, if I could turn back to you, would you help us understand the trends in Australia, where QIC is, of course, headquartered, if those resemble what Vikas has described, seen in other parts of Asia, and how that translates into appetite among other institutional asset owners in the region?
Yeah, happy to do it. Look, I think it's an interesting time. To start, I think maybe some of us are old enough to remember, but the hole in the ozone was over Australia. I think there also is, a lot of resources in that country where, particularly like Queensland, for instance, agriculture and minerals is a big part of how some of the governments and the economies function in terms of, where production and resources are created. And so that's something that gives Australians, a bit more mindfulness around this. In 2022, there was a climate bill that was passed, which is really an emphasis on, I think it's a 2005 or 6 baseline, reducing emissions by 40% to 2030 by 2030. So, there is an awareness and a support in the market, combined with the fact that super funds tend to be maybe industry based, and so as part of that, clearly things like fiduciary charge to your members is important. It is a bit more of a fungible scheme. And so the regulatory bodies are very focused on making sure that there's fairness in allocations and a mindfulness around fees. And so to that end, there is much more adoption or interest in impact broadly, where pathways tend to rally around things related to climate. But that having been said, some super funds are sort of more health and wellness focused, and so feature some of those things in what they're doing. There is an interest in potentially, to attract members to your program, making sure that you have the ability to think about a double bottom line. And so thinking obviously commercially, there is a real push to adopt more of this. And there have been, I think, kind of different levels of adoption by super funds, where kind of, on one extreme, but potentially, small is potentially taking an entire slice of your super fund and allocating it to what is loosely defined as climate investing or sustainability. Others have been more thoughtful and defined, where, our approach is really within those mitigation and adaptation pathways. But it's important to recognize that somewhere between those two things is that, the definition of those pathways is somewhat personal. And so it's important to get stakeholders aligned. And so I think we mentioned this has been sort of a topic of the Compass series in the past. It is something that is still alive and well, and some of that's a product of the way governance functions inside, pensions and the sort of institutional investor marketplace. That having a champion and making sure that you're able to, have the appropriate definitions around those pathways is arrived at prior to sort of starting to commence investing is really important. I do think that there's groups like Tideline that are helping educate the market and progress a lot of that. I think that's been very helpful in terms of additional adaptation. In terms of what our peers are potentially doing, I think with private equity, in particular with Australia, the sort of stage and type are the two sort of axes that people think about this. And so from a stage perspective, recognition that this is probably more of a growth oriented market, and the risk and return characteristics of a growth investment carry with it different potential elements of volatility. So thinking about this in a portfolio context is important. And then I think usually what a lot of folks do is, particularly the private markets, it's the most expensive fee burden in their portfolio. Look at potentially opportunities to invest more directly alongside some of their managers to either positively select idiosyncratic risk in equities and or reduce fee burden, as that's usually kind of at a lower fee base. And so combined, that's what people traditionally do with their private equity allocations. They have to be thoughtful around that as it pertains to implementing an exposure in some of these more maturing categories. But people are definitely leaning in. It's slower than I think we'd all hope. But the expression I've seen is increasingly real around essentially commitment to managers and manager selection, adding this kind of exposure to Australian super fund exposure. But pause there.
Thank you, Zach. And as I appreciate your earlier comment too, that you apply a traditional set of criteria to your impact investments. And I saw some reporting in the last day or two about the first group of large scale impact funds are now old enough that we can look at them and say they are getting competitive returns. So that's another reason I'm optimistic going forward about the institutionalization. I'd love to turn to you, Fran, and I myself will try to be more succinct. I know we want to leave some time at the end for questions, so we'll all try to get through these last questions that I have fairly rapidly. Fran, you've talked in the past about impact investing being an emerging field of practice and a need for more infrastructure in the market. Would you elaborate on that for us and help us understand the gaps you're seeing?
Sure. I will say, Jane, concision is not one of my strong suits, but I'll do my best. So this is like the broccoli portion of my comments, and I happen to love broccoli, and I know many of you do, but will become clear in a second. So we believe at the U.S. Impact Investing Alliance, at the Tipping Point Fund on Impact Investing, that impact investing will only continue to scale with impact integrity if we invest in its underlying infrastructure. Unfortunately, what we call public goods or this infrastructure that enable all impact capital to flow irrespective of your impact thesis, things like impact measurement and management tools, public policy interventions, field research. These public goods have historically been underfunded, inconsistently funded, and at least in the US, financially supported by just a handful of philanthropic players. And so here's the broccoli part. One of my perennial calls to action for all impact investors is to fund the rails you ride on. If you raise impact capital, if you deploy impact capital, you need to support the field infrastructure that enables your work. That was in fact the philosophy behind the creation of the Tipping Point Fund on Impact Investing, which is a donor collaborative that we work on where we pool donor resources to support two of these core infrastructure areas: impact data, metrics and measurement, and public policy. These are areas I would say that are consistently overlooked. They might be considered too complex, recently perhaps too political, perhaps specific or outside of the purview of an individual impact investor or program officer at a foundation. But from my vantage point as a field builder through the Alliance and a field building funder through the Tipping Point Fund, just want to call out these two areas that we think are really important for our collective attention in the years ahead. The first, as Vikas mentioned, is evolving our impact measurement and management practices. At the Tipping Point Fund, we think of that as almost on an evolutionary spectrum. We need to deliver impact transparencies to investors and broader stakeholders, and things like the global corporate disclosure regulatory agenda, private sector standards harmonization, who have advanced that charge. Next, in the evolutionary value chain, we see transitioning from impact transparency, to impact accountability. So things like ratings, benchmarks, watchdog entities, and the ultimate goal being to deliver impact equity by internalizing positive and negative externalities, potentially through impact accounting and other mechanisms. In order to solidify our progress to date, we need to play a role as field actors, as impact investors, in rolling out the current regulatory regime of corporate disclosure and asset manager disclosure standards, striving for global convergence, striving for equity wherever possible. And then the second area is developing the next generation of impact investing public policies. I think Kieron laid out the kind of 4 flavors of public policies really well. So did Beth talk about the catalytic role that public policy can play. The magnitude of the challenges we face requires not just public policy, but also the partnership of the public and philanthropic sectors working in tandem. And so a bit of a call to action on public policy. I think for impact investors, sometimes public policy is like a long game with deferred gratification, sometimes coming, years or decades in the making. But it is absolutely important. The kind of scale impact that Beth talked about can really only be accomplished when the sectors partner. So those are some thoughts about field infrastructure, Jane.
Thank you, Fran. Kieron, turning to you, at the Impact Investing Institute, you've launched a tool to ensure that investment in the transition to a low carbon economy does address social inequality. Would you tell us, please, about the Just Transition Initiative and what kind of capital it will unlock?
Certainly, Jane, but I'll link it to Fran's excellent comments before. I couldn't agree more. I would just make a build, Fran, to what you said, because I think you put that charge to impact investors. I would broaden it to any financial markets actor, because what are we really describing here? One part of play it all forward, we are describing fundamental risks to the integrity of the financial system if the things we're talking about remain unaddressed. So that's really, I think, what's in play. And impact investing is going to be one of the most effective tools we know to transform capital markets in the direction that we're speaking about here. So I would just not +1 to Fran's points, but like +100 to it. And that does link to the Just Transition tool that we've developed. So alongside many others, what is this tool? Essentially, it starts off with what is needed for a fair and inclusive transition to net zero. That's really what the Just Transition is about. I would like to call it the only transition, not the Just Transition, because I think it's the only one that's actually going to work. And back to the question of politics that we've been discussing, we're seeing clearly around the world that unless you can describe to people and communities why the transition to net zero is in their interest, in exactly the way that Beth was drawing out, then you're not going to have political support for the scale of change that's needed. So the very practical question is, well, how do you do it, particularly if you're a large institutional investor? So our criteria are focused on the how. how do you as a large institutional investor align investments in environmental outcomes, in social outcomes, and in community outcomes. And it's a very practical tool for investors to pick up and use to direct their capital allocations. It's now being used by investors globally with about $6 trillion of assets behind them. So it's showing great scale. It's being used both in the global north and the global south. Two things I would say. If you are on this call and you currently are particularly focused on climate finance, I'd really encourage you to look at this tool, and perhaps we can share it afterwards with people. That's a great place to start. How are climate-focused investments working well for the communities around them, and thinking hard about their societal impact. And if you're on this call and you come from a foundation or some other provider of catalytic capital, I'd really look at the tool and think about how catalytic capital can help just transition investments go that much further. Because Beth, the point I was really struck by in your comments earlier was, how are we involving local actors in these questions of the allocation of capital? And that's a really critical part. We can talk about the kind of these massive markets, these global markets, but it all really works best when it has a local dimension to it.
Thank you, Kieron. And following up on that with you, Beth, as well, I'd love to dig a little bit deeper into your approach at Climate United for centering the work ultimately in underserved communities and the beneficiaries, the very kind of practical approach that you take to that. And yeah, be very interested to hear more about that.
Yeah, absolutely. I mean, so as everybody's been talking about, right there, it's an enormous value chain of how to get money moving at scale from the capital markets, where money sits in savings accounts, retirement accounts, pension funds, insurance companies, where money sits, and as we like to say, kind of spends the night, and then how to get those funds invested in products and activities that are actually creating these direct, tangible impacts in communities. And so we at Calvert over the years have really kind of refined our thinking of the chain that needs to exist to make that possible, and really look at kind of two levels of intermediation that's necessary in order to get those dollars kind of from the where it sits in the capital markets into communities. One level is kind of where we sit at Calvert, which is really organizations that understand how to build the products and services that meet the needs of the capital markets: size, liquidity, portfolio diversification, importantly, distribution through platforms and how people buy and sell securities. So how are we creating those products that pierce those markets and really allow people to allocate dollars to them? And then the second level is, how do we then take those funds raised and invest them in local organizations that are on the ground solving problems? And so that can be a local community bank, in the US, a CDFI, a green specialty kind of green finance organization. There's all sorts of local financial intermediaries that exist globally, that are on the ground recognizing what are the market gaps, what are the kind of failures that are inhibiting these projects, activities, businesses from accessing capital or credit, and how are we creating the products and solutions for them. But those are not often the same organizations that are able to aggregate and create the products that meet the needs on the capital market side. And so how are we setting up intentionally that value chain? And so that's how we have created kind of all of our new products, is specializing in that place in the market. But doing so, we think of as basically community first. So what is the problem we are trying to solve on the ground first? And what does the capital need to look like to solve that problem? And then how do we reverse engineer that into a solution that works for the markets and investors overall? And so we're just taking the same approach for the Climate United strategy. How do we design and develop the financial products? Some are going to be standardized financial products, some are going to be more structured solutions, but how do we design and develop those products so that they're meeting the direct need in communities? So for community solar projects in the US, a lot of times smaller developers led by women and people of color don't have access to the upfront just down payments that are required to start the process of developing community solar. And that's just a market barrier to increasing access to smaller communities and smaller developers who really want to bring solar access to their local people. So how are we developing a pre-development kind of loan product that helps with those initial deposits, that initial pre-development support, and takes that upfront risk and allows them to then develop the project and get it online? Similarly, we're looking at the heavy duty truck conversion to electric trucks in the US. Some getting mandated by state governments, and some just starting to be a competitive advantage for independent truckers that drive electric vehicles. But it's the independent truckers that don't have access to credit to buy that vehicle. And so the large corporations can leverage their balance sheets and make up for the high upfront cost of those vehicles. The smaller businesses, the independent truckers, don't have access to credit to do that. So how do we combine tax incentives, low cost capital, private capital? How do we kind of put together the solution to create a total cost of ownership for an electric truck that works for a small business just as it works for a large corporation? So those are the kinds of things we're trying to structure to make sure that we are looking at the problem on the ground first, and then figuring out all of the financial engineering that needs to happen to bring that to market and ultimately kind of educate and transform the broader capital markets.
Thank you, Beth. That's very helpful to understand the rigor of what your approach and the complexity of these problems and what it takes to solve them. Vikas, turning to you and maybe back to the kind of a broader perspective on the region in Asia, from where you sit as head of the region's largest impact investing network. What are these market building needs that we've been talking about in Asia? What's your perspective on what the needs and opportunities are?
Absolutely. So, at AVPN, we've announced 3 initiatives, which I announced at our global convening in Abu Dhabi just a month ago. So firstly, we've formed what we call an Impact Investing Advisory Council. This is a group of 8 very senior impact investing ecosystem personalities representing different pools of capital, different regions within Asia. And we are working with this cohort to really articulate our short-term and medium-term strategy to really catalyze the impact investing ecosystem. The second is around blended finance, and we sit with 600 funders as our members, representing again different pools of capital. So we do believe that we can play a very catalytic role in bringing the different pools of capital to really bring forward a blended finance proposition. And third is around impact measurement. And this is the memorandum of understanding that we have with Bluemark in terms of how do we bring impact measurement and management policy and verification tools to our funder networks. Very critical for us to be able to articulate that and bring that forward. So these are 3 initiatives that we at AVPN are working on ourselves. But of course, we need support from the global and the regional communities as well. So co-investment opportunities, really encouraging partnerships between global and local investors can really leverage capital and expertise. So, co-investment opportunities is what we will work with our regional partners across the globe. And support for policy development, I think it's been mentioned a few times, so providing expertise and funding to create a conducive environment for local impact investing, as well as aligning local efforts with international standards through supportive global policy. So some amount of work that we need to leverage the global community for policy development. And then, capacity development, training programs for local investors and entrepreneurs to really equip them with the necessary skills to forge through a more coherent impact strategy. And look, I mean, cross collaboration and knowledge sharing. So events like this today really will be critical for us to cross germinate ideas and thoughts across the various regions for Asia to also come up the learning curve on impact investing. So a number of initiatives underway.
Thank you so much. And I'd like to float to the group one of the questions we've gotten from those who've joined us today. And Fran, this may be best to you, but I'd welcome others to jump in as well. In the policy space, has there been progress in building bipartisan support for impact initiatives by framing them or reframing them around competitiveness? And I would note myself that Roy Swan at Ford has taken to referring to patriotic capitalism. So is there something to be done or that we're doing around thinking about this opportunity and reframing the narrative with competitiveness?
In the name of time, yes. Yes, we absolutely. We think about industrial policy, can think of industrial policy through the lens of American competitiveness. It could also be seen through the lens of protectionism. So I think a lot of it has to do with how you frame things. And I think, securing domestic supply chains, one bill that Beth didn't mention or just touched on was the Chips and Science Act. I think that securing the takeaway from COVID in part was how reliant we are on global supply chains. I don't think the de facto answer is onshoring supply chains entirely, but I think that it is a place where there has been, some common ground, and yes, seeking to work with centrists on the left and the right to create a shared language and framing for impact investing practices and principles.
Great. And I'll put out one more question to the group around what developments are you most excited about in impact measurement and management? A number of you have touched on developments, but what are you most excited about, and potentially what issues are most problematic? But maybe we'll just any exciting developments. Beth, Kieron, others.
Thanks, Beth. I'm really excited about how the development of actually speaking to people and speaking to people at great scale and getting their views on whether impact is occurring in their lives. There are new technologies out there, new approaches that are just making that so much easier than it was even a matter of years ago. And that's pretty fundamental to ensuring that genuine impact is occurring.
Yeah, I would echo that and just say, the transition in focus between outputs and outcomes is significant. It's difficult. It can be expensive, but it's critical in really looking longitudinally at the lives that we kind of are or aren't changing as intended. And so I think that's been a really exciting call to action for the industry, and a lot of great innovation happening in order to facilitate that in a more cost-effective manner.
Thank you all. And I'll maybe wrap us up now with a very quick round robin question to the team. Quick answers. Where do you see opportunity for innovation to help us strengthen and even transform the impact investing market? And Vikas, you're first on my screen, so I will start with you and then go to Zach and then Fran. And then,
well, I would say it's around, at least for Asia, it's around impact measurement and management. I think funders do need to articulate their IMM policy very clearly and have their impact verified. So that to me would be critical.
thank you. Zach, to you.
I mean, I selfishly think about capital formation with emerging managers and see that as a really interesting opportunity for investors like ourselves to support growing platforms to invest in really interesting opportunity.
Great. Fran.
Yeah, just picking up on something that Kieron mentioned in his opening remarks, that we believe that transforming the market will require transforming the underlying norms and regulations that govern the capital market. So things like fiduciary duty and materiality. So We do a lot of work around, imagining the future of fiduciary duty, the obligation to take financially material impact factors into account, the concept of double materiality, and think potentially something that can bridge single to double materiality as the concept of system level investing that asks investors and others to consider system level risk, beta risk, and become active systemic stewards to address economy-wide risks like climate change and inequality.
Thank you, Fran. Beth, to you, and then Kieron will give you the last word.
Hard to beat Fran's answer, but I would just say innovation around data collection, aggregation, dissemination. I think what has held us up for a long time is the lack of ability to compare apples to apples on performance and kind of asset level performance, fund level performance. We're seeing, just given the maturation of the market, we're seeing a lot of that now, and really excited by the potential of really reducing the gap between perceived risk and actual risk in so many of the markets that we serve.
Kieron, to you.
Thank you. Well, this has been an amazing discussion. I'm really excited just by the talent that is coming into this space. There's always been a lot of talent in this space, but kind of the sheer inflow of it. I'm particularly going to age myself here, but particularly those who might be slightly younger, bringing a slightly different perspective, a slightly more holistic, and at times a slightly more urgent perspective as well. So I'm excited by that.
Well, thank you. Thank you to our panelists for joining us today. It's really been a great conversation. I'm taking away a lot. I think institutionalization of the market, changing this narrative on the fiduciary responsibility, and I really love the call to action to support the field. So many takeaways, but those are a few that jumped out to me. Big thank you to our panelists and to all of the participants who've joined us today. Thank you.
Thank you.
We'll see you on the next one.